increase limits to 15% to private equity, 45% to infrastructure in 2023. So in the greater scheme of things, it's still very recent. And there's been lots of other priorities where I think the first part was diversifying and looking at how you can access returns beyond the JSE.
SAVCA, as the industry body, doesn't just represent GPs. We also represent transaction advisors, including accounting firms, law firms. A lot of the work that we do is also advocacy and, policy regimes, like, influencing a lot of the policies with National Treasury.
Okay, you can take, I don't know what the saying is, the elephant to the water, but you can't make it drink or something like that. So we've got a responsibility where we have to help the entire value chain become more comfortable as players within the industry. So Anusha, you mentioned training that you're doing for trustees and other training that you do for, call it private market professionals and so on. I just finished writing a fully online private markets for trustees course.
Progress doesn't happen overnight. It's built deliberately, patiently over time. At Old Mutual Alternative Investments, we invest where capital can do more than grow, where it can build. We finance infrastructure that keeps economies moving, energy that powers homes and industry, schools that educate future generations, businesses that create jobs and resilience. Because behind every asset is a human outcome, a light switched on, a classroom filled, a community connected. We manage capital across private markets with one clear belief: long-term returns and long-term impact are not opposing goals, they are inseparable. This is investing with purpose, with discipline, with conviction, turning Africa's structural challenges into investable opportunities and patient capital into lasting progress. Old Mutual Alternative Investments, building real assets, creating real outcomes.
Ladies and gentlemen, welcome to the final episode 12 of Inside Private Markets here on EBNet Stream. For 6 months now, we have been unpacking all the good and the bad of private market and infrastructure investing. We spent a lot of time providing you with information to empower you to be able to consider this opportunity as an opportunity for your capital, be it as an individual or as a pension fund. Today we bring the series to a close, and we close pretty much where we started, with our very first guest, and the only guest, I must say, to appear twice on the series, that being Naveen Lala, Client Director at Old Mutual Alternative Investments. Naveen, welcome, and how do you feel to be the only repeat guest ever on this series?
Morning, Leon, and hi, Anusha. Wow, I didn't realize that. I wish I knew. I would have scripted a thank you note and made sure I got my mum to watch.
Well, you can always forward her the series and she can pass it on to her friends as well. It will live for a long time on EBNet. So today we're going to be talking about the future of private markets investing, given what we have been talking about and unpacking over the last while. So who better than to join us, what I call the face of private markets investing in South Africa, the CEO of the South African Venture Capital and Private Equity Association, or SAVCA as it's known, Anusha Naidu. Anusha, welcome. Thanks for joining us.
Hi, Leon. Thank you so much for having me on the podcast. Very excited to be here 4 months into my new role as SAVCA CEO. So yeah, really the champion of private capital in Southern Africa.
100%. I say you've got the most, well, first of all, the best and most important job for in South Africa at the moment, because we've spoken ad nauseum about how important it is to see private capital support private market investing in South Africa. That's the engine that we need in order to grow our economy and create the future for this country for all South Africans at the end of the day. And it's the capital that we need to deal with a lot of the injustices of the past and create an economy that ultimately is there for everyone, not just a few people. So on that note, and I have raised this question with you before in passing, which is, why do you think we speak about private market investing always starting off with the negative, about what the problems are rather than what the opportunities are?
Yeah, I think in any investment, we always need to think risk. So we do need to think of what the challenges are and how you mitigate for those risks. And that's exactly, why SAVCA exists as well. As the industry body for private capital in Southern Africa, we represent approximately 240 billion in AUM, representing almost 240 members. SAVCA had a revised mandate in September last year, not just covering private equity and venture capital, but now including infrastructure, private debt, impact investing, growth equity, etc. So it really is, following the path of our investor pool and our member pool and representing that in the space. So yeah, I think for us, a lot of our work is a lot of education and capacity building, training, understanding the specific nuances of private capital. We live in a world with so many global risks that we haven't faced, in prior years. Post 2020, I mean, we've been living through wars, economic uncertainty, massive geopolitical risk. So yeah, the risk is everywhere, even in the listed space. But I guess it's contextualizing and understanding what the risks are in private equity. And sometimes the risks are not what we perceive them to be. Often we hear, oh, there's no liquidity in private capital. But how much liquidity do you actually need in the space? So it's sort of thinking around what your investment thesis is, what your investment themes are, and how you build your portfolios and build diversified portfolios.
And I think that's spot on, because it's not, first of all, it's understanding the risk. Every single investment opportunity comes with some form of risk. It's like we always used to have the old adage where we would say investing in cash is the less risky position, but it's not, because you won't achieve the returns you require. So it's guaranteeing you a poor outcome at the end of the day. So it's probably your highest risk position to be in from a planning for retirement perspective. And it's exactly the same when it comes, in my mind at least, and this is what I try to encourage asset owners or trustees of pension funds to think about, is that you're creating a future for your members. That future is about their nest egg that they'll have, but that nest egg is to sustain them in the environment, the life in retirement. And they want that to be a life in an environment which is conducive to living healthy, to not having excessive healthcare costs, to not having to pay excessively for security and all of those kind of factors. And to make that happen, it's a bigger picture. We've got to stimulate our economy. We've got to stimulate the growth and the health of the environment that we are all part of. So by not investing and not supporting private markets, you're taking on that risk. Rather look at it from that perspective. By not investing in private markets, you're perhaps missing out on a massive opportunity for growth, because there are so many private companies out there that are innovating and coming to the market and are disrupting and changing the market, ultimately where the JSE is shrinking. So again, I keep on wanting to express with passion the holistic picture. Yes, there are risks in private markets, just like there's risks in listed markets, but there's the other end of the spectrum as well that you need to consider. So Naveen, with that in mind, you work for Old Mutual Alternative Investments, one of the leaders in this field. Obviously, you guys see that opportunity and you're taking advantage of that by providing quality product to customers, making it accessible for them to invest in private markets. How do you see this panning out? There's been slow take up from pension funds in particular. Do you see that headwind changing? Are you finding that trustees are becoming more comfortable with the concept?
Absolutely. I think we are early in the journey. So Reg 28 increased limits to 15% to private equity, 45% to infrastructure in 2023. So in the greater scheme of things, it's still very recent. And there's been lots of other priorities with, I think the first part was diversifying and looking at how you can access returns beyond the JSE. And the natural first step was looking at offshore, because offshore also increased to 45. And I think managers have been, and pension funds and multi-managers have been focusing on that for a long time. It's been part of their wheelhouse for a long time, where private markets to a lesser extent. And listed markets have done phenomenally well for retirement funds and investors over multiple decades. So it's been a good place to be. But there's been a structural shift in markets. And since the financial crisis, where there's been this reallocation of capital. So you've got areas where banks played exclusively, where they're playing to a lesser and lesser extent. And that's opened up to private capital to fill that void. So that's the one theme. The other part is that there's so much more private capital available to keep these businesses private from both an equity and debt funding perspective. And a lot of this, like I said, from the global financial crisis, it drove, call it in the big markets, developed world, interest rates to zero. So you needed to find other avenues of finding yield. And those avenues were private credit, mezzanine financing, hybrid capital, infrastructure debt, etc. And it opened up a completely new asset class. And that has continued to grow and grow and grow. And then, of course, private equity has always been a big feature within private markets. So if you look at your P7 pension funds, which is the 7 largest pension fund countries, and in the early 2000s, they were under 5%. And they've incrementally grown to where they are now, 20%, and some funds up to 40%. So we are early in our journey, and I think the way we've been tracking, my sense is that with our infrastructure requirements, our impact requirements in terms of developing our country, we've got lots of tailwinds that will place us on the same trajectory. So I think pension funds are becoming more familiar, and I think that we are on the right trajectory. And coming from the Batseta Winter Conference, the conversations year on year are becoming richer and far more relevant.
So I'm pleased to hear you quote those numbers around the developed economies versus ours, because it makes it sound like that we're going through the phases, and ultimately our time is to come. In terms of that, and all of the headwinds are there. I mean, after you mentioned the Batseta conference, Minister Godongwana was there, where he spoke about the need for 400 billion in capital to support water infrastructure in South Africa. And I was doing some calculations the other day that if we move from our current 2 to 3% to just 10%, that's about 500 billion worth of private capital flows into private markets. So that opportunity, that business opportunity, it's a fundamental shift in terms of the asset management world in South Africa. But the reality is we have to make sure that the asset owners, the trustees of those pension funds, have comfort in what they're investing in. So Anusha, without putting too much pressure on you, it's your job. So how are you going about doing that? I thought what you guys were doing with Batseta was wonderful. So maybe you can also unpack that a little bit.
Yeah, for sure. Thanks for that, Leon. So, I mean, like Naveen alluded to earlier, it's still private capital in terms of Reg 28 allocation is still early days. And SAFCA research shows that pension funds allocate less than 2% into private capital from a 15% allocation. So we are hoping over the next couple of years that grows as there's more capacity building, training, and understanding of the space as well. So I was very encouraged to be at Batseta, where you have the whole universe of investable assets in the space. And we had 3 private capital sessions. I was on a panel discussing venture capital and how venture capital has stimulated entrepreneurship and technological innovation in South Africa. And, was joined by quite an esteemed panel, fund of funds, asset consultants, the principal officer of one of the pension fund trustees, and the entrepreneurs in the space as well. And, the support and backing of venture capital stimulating entrepreneurship. And what's generally very encouraging in the research that we see as well, a lot of the VC entrepreneurs tend to invest further in the ecosystem by developing their own funds and other businesses in the space. So you really have that accelerator impact that extends far beyond just the one business that has been scaled up. So at SAVCA, for us, it is very important to be in those rooms. The other 2 sessions that were very significant was Naveen's session, where there was, the alternative space, looking at infrastructure, investment ethos, and, what the fund managers are trying to achieve in terms of all of the social impact, the infrastructure impact, and how that is really creating the stimulus to drive economic growth. There was a lot of focus at Batseta on infrastructure, which is really the foundation of many businesses. Businesses can thrive, investments can thrive if that baseline level of infrastructure is there. You're not having to worry about electricity supply, water supply, sanitation, South Africans, it's a topic very dear to our heart. It's something we've lived over the last 15 years, having backup generators, having to solve for, problems that are way beyond your day-to-day business generation. So the other session was also private equity at Batseta, and talking about significant exit opportunities and, the last year's IPO listing of Optasia on the Johannesburg Stock Exchange. So again, very different themes, but very cutting edge themes as well. And definitely in private capital, it's the driver of economic growth. It is the driver of innovation. If you think about a lot of the tech companies that we are so reliant on, a lot of them do stay private for longer. And it's being able to invest in those early stage businesses where the value creation is actually so much better in the space. So what for me is very encouraging is that we are represented in the rooms, and we're hoping to continue to be represented in the rooms. And there's more GPs that are in the space as well, and pension fund trustees, principal officers, wanting to hear more about what we do in private capital and how we think about the future of the country. For us at SAVCA, we do provide a lot of the capacity building and training in the space. So, we do the Gibbs Foundation program, which is a very interesting baseline level of entering private capital, where you understand the different nuances, the fund structures, how that all works. And a lot of it is jargon. I mean, Leon, you always make quite a few jokes about it as well, but it's learning to speak the language of private capital. And this is, industry-wide, global sort of terms that we're using. So it's for us being able to speak that same consistent language. We also tend to do bespoke training for pension fund trustees. And this is something we're more than happy to do, covering the different elements of private capital, and happy to go with the trustees' pace. Also very cognizant that pension fund trustees have varying levels of experience in the space, and at SAVCA we're more than happy to provide that training. So yeah, I'll leave it at that.
Anush, when you said 240 members of SAVCA, is that member firms?
So it also includes advisors as well. So SAVCA, as the industry body, doesn't just represent GPs. We also represent transaction advisors, including accounting firms, law firms. A lot of the work that we do is also advocacy and, policy regimes, like, influencing a lot of the policies with National Treasury, SARB. We just submitted industry feedback on exchange controls, the capital flows. We tend to do a lot of the work on the interest deductions in the space. So yeah, we have quite a wide continuum. We represent GPs, LPs, transaction advisors in the space.
That's a massive ecosystem when you think about it compared to the listed space. That's quite substantial. And I was just thinking that.
But I think it's an important point, Naveen, because I don't think the viewers always fully appreciate that. I mean, the private market space is bigger than the listed space. That's the reality in terms of investment opportunities, in terms of impact on the economy at the end of the day. It's just been a little bit more behind the scenes and not as prevalent. Why? Because the listed markets is the JSE and it's out there kind of thing. But the growth that I have no doubt is going to take place. There's a question I have around that related to SAVCA's role and then the membership. So trustees of pension funds, you've got the bigger pension funds where they have, call it, their professionalized teams of investment guys that sit and analyze and look at the different opportunities. Not most trustee boards don't have that. They rely on an investment consultant or an employee benefit consultant. They're unlikely to try to work through some incommodant partnership or whatever these things are called and then pay the fortunes to attorneys to check those agreements. So they need help investing into other types of solutions, funds of funds, or whatever it might ultimately be. But they also need to rely on the expertise of the asset managers, or what's called GPs. So there's two questions I have here, one for each of you. In a world where there is significant growth, there's always guys that try to take advantage. And I think about impact investing as an example. It's easy to claim that I'm offering you an investment opportunity in private markets that's going to have massive impact and solve all of the world's problems. Right? You can be quite easily taken by that, and perhaps it doesn't achieve what's on the can at the end of the day. But as SAVCA, when you have members, what comfort does that give to the investor that there's a certain, what's the right word, credibility behind that party?
Yeah, so, the SAVCA member does participate in research and, industry surveys, etc. And there's a whole new member committee that goes through new members for SAVCA, looking at the structure, the organizational structure, looking at regulation, etc. So there is a level of comfort there. We are not the industry regulator, and I think that's a very clear distinction that we always need to make in this space. There is still regulatory requirements that GPs need to comply with, and diligence is important in any space. If you are investing, you need to understand exactly what you're investing in. So I definitely want to draw that very important disclaimer there. The beauty of private markets is the diligence process. With listed entities, you don't have a lot of scope to have management sessions and ask questions, etc. Whereas in private markets, you have the ability to connect with the management team a lot more frequently. The GPs, that's their secret sauce. That's how they are able to look at value creating opportunities. It's board seats, it's board representation. Really being able to drive the journey of the business and where the business is going. And there tends to be, quarterly reporting, quarterly management calls, like we said, the board representation as well. So you really are in the driving seat in terms of where the business is going, more so than with a listed entity. I think of a COVID environment, and in my previous life, I was doing private debt as an issuer. And in COVID times when things were so uncertain, we were having weekly calls with our investor pool. There was just so much uncertainty, and a lot of our investors were internationals, and trying to give them comfort in terms of what was actually happening on the ground in the markets that we operated in. So you wouldn't really have those briefing calls as regularly in the listed space. What I also find is there's a lot more collaboration in the private market space. It is very much relationship driven, and there's a sense of people wanting to help each other out, and there's always questions and member directories and things like that. So you also touched upon the fund of funds structure as well, which I think is, a very interesting way to start investing into private capital, especially on the VC side, where you're not picking one single GP, but you're diversifying your risk in terms of that. And there are, quite a lot of new fund of funds structures that are coming into the space, and proving that the hypothesis actually does work in the space.
I suppose the reason I'm asking the question is not to try to reinvent the world, but it is a bit of a concern that I have because of that growth, and because there's always people that want to take advantage in that regard. And I'm not yet fully convinced in my own mind that the regulator knows exactly what's the right word, requirements to place on private market players, GPs, and what they need to deliver on and what the rules are effectively around them. So I don't know if I'm being unfair about it, but I think all you need is one case to go wrong, and it taints so I almost think about hedge funds as an example. I mean, hedge funds have got such a bad rap because of the fees and guys making massive amounts of money off hedge funds that pension fund money doesn't want to go there any longer. So to protect that space for private markets, I think is part of the future, and the role of SAFCA going forward is important. You want to see successes coming through. Yes, there'll be the odd failure, but I almost want to say for the right reasons, if I could put it that way.
Yeah, for sure. And I think that's why the diligence element becomes so incredibly important. And, sometimes we do talk about the income and deed structure being, quite difficult to understand, but this is, very established mechanisms in the space. It's not a new mechanism. The LPAs are very structured. They have specific terms and conditions, which is very standard across the industry. So you should actually be wanting to see these sort of things in your GP. And not shying away from it. It does provide the investor protections.
The first time the income and deed partnership was ever mentioned to me, that was immediately at that point where I said, I don't understand. Couldn't understand the words, so I didn't want to go there. But I think it's an important one because they are there to protect you, and they are established. So as much as it might sound complicated, they're there to exactly achieve what you might fear, or what to counteract it. But coming to Naveen, on your side, you guys have been excellent at creating accessibility for pension funds to get exposure to private markets, and looking to also deal with liquidity type issues. So can you unpack for me what you guys as Old Mutual Alternative Investments do to try to make the paperwork more simple, and to try to solve for some of the other risks that pension funds get exposed to?
Sure. On the liquidity side, we've been in a fortunate position that we've got a multi-asset platform, that has multiple private market assets, from private credit, your traditional credit, high yield, hybrid capital, mezzanine, private equity, infrastructure, etc. And each of those have different return profiles, risk profiles, and liquidity profiles. So you're able to cater for clients' needs in terms of what their requirements are. So the two-pot system has been fantastic in terms of creating this long-term patient capital bucket, which liquidity shouldn't be an issue. And I think that's that's been game-changing, I think, for private markets. And I think pension funds will start utilizing that feature more and more. From an accessibility perspective, our I'll use an example of one of our infrastructure funds. I think it's well known, the Ideas Managed Fund. It's about 30 billion in assets under management, diversified across over 60 assets. It has a natural yield because there's lots of operating assets and cash flows. So it pays out biannual distributions. So investors are able to access some form of liquidity. And it's an open-ended fund, and we also have the ability to satisfy client redemptions on a 12-month notice period, which I think is pretty fair, and I think it allows a lot of flexibility for pension funds in terms of incorporating it into their planning. On the private debt side, or the interest-bearing basis, you've got they're naturally self-liquidating because they various forms of loans. So the term of the loan, the interest rate, whether it's an amortizing loan where it's paying principal and interest, or whether it's a bullet coupon where you're servicing call it biannual coupon with the principal paid in at the end. So most of them are blend of the two, with mostly being amortizing. So what happens is investors are receiving capital and interest back from the very early stages. And it's not entirely back-ended like you would have with typical private equity or VC. So that's an important liquidity feature, which allows them to access higher returns with liquidity. And I think those are the key ways in which we've addressed it. And then the delivery vehicle has been in an insurance wrapper.
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za.
So that's exactly where I wanted to go. I mean, I come from the world where we've used insurance wrappers to make the legalities a lot simpler for customers. So having one wrapper rather than multiple agreements across many different asset managers. And it's very similar in the private market space, as you guys have been doing, that rather than having to take on the burden of complicated agreements, you have one insurance wrapper agreement, which is quite commonplace and funds are used to, and through that they can get exposure to multiple underlying private market opportunities. And within those, you can also manage your liquidity, because not every private market opportunity has the same liquidity brush at the end of the day. So that multi-asset approach is another way of also managing the ultimate liquidity that you need. It's not either one or the other. There's an in-between.
I often get asked about liquidity and the illiquid nature, which often is a concern for pension funds. And my response is always that illiquidity is a feature. It's a positive feature that allows you to harvest this risk premium of the benefit of long-term investing. And so number one, it's a feature. Secondly, if you're at your max limit of 15% in private assets, excluding infrastructure, which could go to 45, I'd ask, how often has your pension fund had to terminate managers across the board to get 15% worth of liquidity? And the answer is never. The other part is, what's your natural attrition rate in terms of your cash flow, your liability drawdowns per annum? And I think they're typically from the anecdotes I've had, is about 5%. So 5%, you're getting a natural yield out of divvies and your fixed income component in terms of distributions paid. So I think the liquidity is very much a perception. And if you need to take 15% out immediately, you're taking on massive market risk, which is an additional risk. So I think just the perspective, it's people want liquidity, which they actually will never use or need, and historically haven't required.
So I agree with that, but the reality is a trustee has a fiduciary responsibility to sit there and say, right, in the worst case scenario, what do I do? Now, that worst case scenario, yes, might be one in, I don't know, 1,000 chance or something like that. But the ones that they do need to be cautious of is in the event of there could be retrenchments or whatever that take place, and they have to pay out the members. They've got to get them their cash. You can't give them an in specie transfer. It doesn't pay for the rent and the food and stuff like that. But also in the event of a company going, it's being liquidated. So I keep on looking back at the industry, and I think to myself, we put together blended finance type structures. Why can't there be a blended finance type structure that helps in those liquidity events or something like that? Have we ever thought about things like that? Now, I don't know the answers to this. I'm throwing it out there. Anusha can take and run with it as well in terms of people she speaks to. I'm raising it with everyone I speak to for what it's worth. And I always look there behind you. There's Old Mutual. Oh, big balance sheet. Right, surely your actuaries can price up that in those very unlikely events that you just mentioned, okay, for a small premium, you can cover and pay out at least at book value to those investors. It will just take that anxiety, that worst case scenario off the table. But we don't need to comment and solve that. Okay, that to me is something I think where we can innovate further in terms of it.
As a natural progression, as the industry matures, you'll see more of that coming on because it's a massive balance sheet requirement. But what's happened in the developed world, it's that to cater for liquidity, fund investors have allocated across vintages. So they're diversifying across vintages, and which means diversified across J curves and different life cycles. So while they're investing in one fund, they would be receiving distributions from a prior fund. So an example with investors in a hybrid capital fund one, the fund's liquidity had exceeded the expectation. So they are getting far more cash back. And if they, for the second investment into our fund two vintage, if they had to put if they put $100 in and had to put $100 into the second one, they would still be getting more money back than they're actually putting in. So what most of them have done is they've increased their size by 2.5 times to make sure that they're matching that profile so that to maintain the exposure, taking into account distributions received and drawdowns paid in. To maintain that exposure, that was the number it arrived at.
So I think the message to the market is the liquidity debate ends up being this opening ambit in terms of private markets, and it destroys me because I just think to myself, but guys, think about the other side of it. Think about the other risks that if you don't do it, what could happen. So I think the message we need to leave with the audience is we can solve for the liquidity issues. All of that is ultimately solvable. Don't let that hold you back. Engage in the opportunity. Speak to your consultants and your advisors about it so that you can consider what you might be able to do or want to do in that space, because it's in your interest to do that in order to manage your overall risk profile, in order to cater for the future, to enhance your returns, many different good reasons that they should, and there's mechanisms to help them do that responsibly. The reality still is, okay, you can take, I don't know what the saying is, the elephant to the water, but you can't make it drink or something like that. So we've got a responsibility where we have to help the entire value chain become more comfortable as players within the industry. So Anusha, you mentioned training that you're doing for trustees and other training that you do for, call it private market professionals and so on. I just finished writing a fully online private markets for trustees course, which is really about trying to make it practical. Just trying to understand the practical things that they can do. But there was a report that was compiled by the FSCA, and I think it was the IFC back in 2019. It was just before COVID, where they asked the question around responsible investment practices and sustainability policies. And pretty much every pension fund, or 80+%, had a sustainability investment policy. They then asked the question, who's monitoring it and what have you done? And it was less than 15% of people have actually re-looked at it ever. Okay, they sort of put it in place and then forgot about it. There's another report to come out shortly called the Responsible Investing Report, which the FSCA has again called for, and I think the results are going to be interesting, if not similar, in that regard. We'll actually be covering it as EBNet, the report, as soon as it's released in a month or so's time. So the question is, how do we get people comfortable? It can't just be education. You guys hold conferences, a VC conference, a private equity conference. What's the purpose of that? So those are the questions, Anusha, to you, and anything you want to add to that discussion. And then Naveen, as a player in the industry, as a GP or one of the largest providers of private markets opportunities, what is your responsibility in order to help customers ultimately gain that comfort? So Nisha, let's start with you.
Yeah, great. So I think, in South Africa, there is a perception with international DFIs and impact investors that it's fully funded. It's, deep and liquid capital markets, that there's no short supply of capital available. So we often, when we talk to international DFIs and impact investors, they tend to look at outside South Africa because they think that there's more of a development need and that acceleration impact, and that's where they should be deploying their capital to. So I think for us, it's a lot of that education. So yes, they are correct. We've got deep and liquid capital markets, very established pension fund regime, very stable legal framework, and very well executed lawyers and transaction advisors in the space that have a lot of experience. South Africa is one of the few markets on the continent where you don't have to have an international lawyer that comes on board as part of your legal DD because the frameworks are so good. So for us, it really is driving home that message that there's a bit of a perception risk with international DFIs and impact investors, that pension funds are allocating such a small percentage of their allocation to the space. So there is still a requirement to crowd in capital for them to look at blended finance solutions, first loss, trying to come in as anchor investor in certain funds and fundraising. So it's trying to marry that perception of what you might think is in the space with what's actually happening on the ground. And you're right, SAVCA as the industry body, we think that convening is a very important part of our mandate and bringing capital allocators together, including international DFIs and impact investors, and being able to translate the SA story, the fact that there is a little bit more policy certainty. We've definitely seen that on the energy side, and that's created a lot of impetus for more investment to come into the space. We're needing that to happen now with water. So proving that very successful track record to investors that you can actually come into that space.
Can I get another suggestion just off the top of the head that I actually it just came to me now, because I think it was the prior episode I interviewed Vuyo Ntoye from African Infrastructure Investment Managers, as well as Rio Papier from Old Mutual Private Equity, and we spoke through case studies of success. It'll be interesting and fascinating to see more and more case studies of success coming from all across the industry, because that helps build confidence. It was the first time I had listened to these two particular case studies, and as a person in the industry, I'd never heard of it before. I'd never engaged with that, and listening to it was refreshing to understand not just the success from a return perspective, but the impact it had on the communities around the project and all the rest. And when you hear that, I don't know, the heart wants to get behind it, if I could put it that way. So it'll be good to see that from more and more of the SAVCA members sharing these successes if they can. And from an overall industry participants perspective, I believe that the Old Mutual shouldn't be competing with any other GP. We should be collaborating to build the industry and to build the asset opportunity, which might be a difficult one in the commercial space. So I'll look at Naveen and I'll ask him to comment on that. And then also, again, what is your responsibility as a GP in this asset class in terms of holding the hand of the customer to ensure they're comfortable?
It is exclusively alternative investments or exclusively private markets. So we manage 160 billion in assets under management. 100% of that is unlisted private assets. So while we're not the custodian of the industry, we want to make sure we've got a strong impetus and we care deeply about the industry. Is that about what we can do to play our role in journeying together with pension funds and investors to get more comfortable with the asset class and understand the risks, understand the opportunity, understand the impact, understand the main risk gets not participating in this. And I think there's this virtuous circle happening now where with more and more private capital becoming available, you're going to have the private market asset universe increasing. So the opportunity becomes more and more in the private markets, and eventually when the capital requirements for private companies are so large, they'll go public, as an example of the OpenAI, Anthropic, SpaceX, etc. But most of the juice happens prior to that. So we want to help investors. We're also doing our bit in private markets training, which all pension funds are welcome to engage us with that, and we'd love to do that. We often collaborate with other GPs, and one of the the point I've made is that the folk ask worrying about competition, and I said we'd love the opportunity to compete, but let's get everyone in the arena so we can start competing.
Yep.
At the moment, what's there to compete with? So let's develop the investor base, let's build the asset class, and let's get the confidence going.
And I must congratulate you guys, because at the advent of this podcast series, actually, when I spoke to you guys and I said, look, this is about, helping educate and uplift the market around private markets. And as soon as I said that to you guys were immediately on board without any questions around, well, what profiling do we get, and so on. So that's pleasing to see, and I think it's necessary that we adopt that culture across the industry. But I see Anusha's, she's biting at the bit. She wants to
Yeah, so I just also wanted to add, so we talked about the training that we do, the very bespoke training, and then the training cycles throughout the year. But you did also mention the convening and the conference elements. And, that's a very lived example of the deals, the themes, the trends that we are seeing in the industry. And it's sort of giving you a deeper dive to understand who are the players in the industry, what are their concerns, having those conversations. So, we had the SAVCA PE conference in March, and it was, a very, very interesting conference, bringing everyone together. Later in September 10th, actually, we've got the VC conference that's happening in Cape Town and Harsendal. So if this is something that you're curious about as a pension fund trustee, principal officer, definitely encourage you and your teams to come out and actually see who the players are, see what the trends are. And, also just a call to action as well, in terms of the industry data and benchmarking that we do, as well as the research. I mean, SAVCA does the annual surveys, and that participation is so important. I mean, we obviously know, from our previous life, that when you're a deals professional, you are very busy in executing on a deal and getting the deal done. But it's so important that we are celebrating these wins and these themes. And, like you said, the numbers are super important. We want to be able to see the quantitative data, but also the case studies. And what I've actually been talking to my team is also spotlights on members as well in our communication, because we have to actually amplify the voice of private capital and actually celebrate what people are doing in the industry. Fund closes actually taking place much quicker, having anchor investors come on board much quicker. These are definitely signs of maturity in the space. And, we're also looking at the SAVCA fellowship program as well. So also developing the next generation of leaders in the space. So, in the private capital space, we're always thinking of exits and succession and what happens next in these private companies. But we also have to think about it in our industry as well. So developing that next generation of leaders over an 11-month program. So there's so many different elements to this in terms of that curiosity, asking the questions like, okay, what does private capital actually mean? There's so many different asset classes, all with their different nuances, and just really encouraging the investment community to ask the questions, to engage, and to reach out. We're always here to support.
So I'm a big believer that South Africa needs to solve for its own problems before it looks beyond its borders. And I think that should always be the starting point. And we've spoken a lot about this, bringing private capital into private markets, developing our economy, solving for the challenges that we face, and doing that by making sure people aren't forced to do it, but that we celebrate doing it because we see the opportunities that lie there. But I want to put one thing on the table that then takes us one step further, which is the attraction to international investors to come and be part of. We always talk about this African dawn. I mean, we've been talking about the African dawn now since I don't know when, right? At what point in time do we stimulate the development and the growth of Africa and attract international investors into this new investment opportunity that exists, which is so underserved at this point in time? Now, I'm a shareholder in a private markets related business in Europe, and I've asked the question of my fellow directors and shareholders there as to, is there an interest from European pension funds, private capital, family offices, and so on, to invest into Africa private markets and in particular impact Africa? And the answer has been there's some interest, but there isn't sufficient deal flow in that regard. Is that an accurate assumption, or should we be getting out there together and promoting Africa and South Africa as the hub into private markets in Africa to ultimately develop that African dawn?
Yeah, 100%. I think, for the reasons that I alluded to earlier as well, South Africa is one of the more established private markets space on the continent. A lot of the corporates and a lot of the, the financial institutions have that same sort of level of strategy expanding into, a Pan-African footprint. And it's a natural progression for private capital to also do the same. And, I think I've spent a lot of my career working in international markets, and sometimes as South Africans, we can be very insular with not talking about our stories, and we need to be able to do that to actually get the attention. We need to, have these conversations with the international investors. And the DFIs, family offices, a lot of them do have that additionality element. And I think it's understanding what the fund mandates look at specifically and how you're positioning that. So I think it is a very natural progression over time, given the progress that we're seeing and, the African Continental Fair Trade Agreement, all of these things coming into play. So South Africa really is the entry point, as well as, East Africa, Kenyan markets, so more collaboration across the continent.
So Naveen, you guys have got an African infrastructure business. How is that going? Is the deal flow there? Is the appetite for capital there?
Certainly is. So we are on our fourth vintage in our Pan-African mandate, and we were looking to raise around $500 million. And so we were in market. We closed end of last year or end of 2025, and we were oversubscribed by 1.5 times, if not more, which certainly exceeded our expectations. So there was lots of appetite for it, and most of it was virtually entirely offshore capital. A lot of European DFIs. DFIs have been playing in this space for multiple decades, and you've had lots of non-European non-DFI European investors. So some pension funds, foundations, endowments, family offices, etc. And likewise, we have a climate accelerator fund. And what that's doing what that's also attracted has been lots of European investors, because it's within their culture, within their ethos, in terms of impact, climate transition, etc., where Americans are, and it's not in their wheelhouse, so to speak,
Yeah.
or focus.
So I think it's a tip of the iceberg, and we've got more work to do there. These European pension funds, I've sat in meetings with them where a single fund is bigger than our entire economy. So the opportunity set with the impact thesis that they have and the interest they have in terms of supporting development, I think there's massive opportunity for us to take private markets to a new level without just relying on the South African capital, which should be there first and foremost. But guys, I see our time is nearly up. I mean, I always love having these conversations that can keep on going forever. I'd like to just close off today by first of all saying thank you to both of you for attending and sharing your thoughts with our community. But also especially Naveen, to you and to all of your colleagues back at Old Mutual Alternative Investments for getting behind this podcast series. And the value that you guys have ultimately brought to the community. I've got no doubt that we've moved the industry forward, albeit just a few steps through the 12 episodes that we have held, and it'll live on. Essentially, it'll live on as we continue to promote it, and it'll be available for trustees to go watch, learn, and ultimately engage further from that. And Anusha, to you and Safka, you mentioned your conference, and I wanted to bring that up specifically because I attended your PE conference earlier this year, and there was one thing that I left when I departed from that, which was energy. And that's what I felt the whole way through that conference, was this incredible energy of what we can achieve together as South Africans. So that's what it's there for, and that's why I'd encourage others to get involved. It's a good feeling to be part of that. So guys, on that note, thank you very much. Final word, Anusha, from you, and then Naveen, and we'll cut off.
Yeah, just amplifying the theme of energy. I think the energy of South Africans to make the country better, to actually plan our future in the country is actually quite incredible. The ability to solve a problem, I think we don't actually sometimes understand the weight of that. The ability to plan for different scenarios. There's no sort of social construct in South Africa that you see in a lot of the European economies that I've worked in previously. So I think it's just amplifying that a lot more and being able to collaborate. And like I say, ask the questions, connect. If there are concerns, let's address it. But I think it's a very exciting space. I'm incredibly energized and excited about what lies ahead for the industry. And I think, it's just recognizing what we do. So thank you to Old Mutual as well, and Leon for this podcast series. It's been incredibly interesting to listen to the different themes, the different players, and how we connect the dots together as an industry.
Great. Well, thank you for that. I know you need to drop off. You've got another meeting, so feel free, because Naveen's never said anything quickly. So let's hear what he has to say.
Thanks, Leon, for the prompt to be more succinct and short. But I think the opportunity is there. While few pension funds by percentage of AUM have allocated, there are many. It's a broad field where there are many pension funds that have embraced it and have large allocations. We've got a pension fund that has 20% exposure to infrastructure with us. And it's because they've had a good experience and they've kept on reinvesting and taking up in new fundraising rounds. So what we found is for most of our subsequent pension fundraisers, a lot of them are existing investors. Why? Because they've had a good experience and because the cash flows they've got back has actually exceeded their expectations. So to maintain the exposure, they've come back and followed in subsequent vintages. So I think once investors start experiencing this asset class more and more, the experience will drive them to continue to allocate. And I think that creates that energy within the retirement fund space. So a lot of energy as well, a lot of excitement, a lot of opportunity. And a big thank you to you and Anusha, and specifically yourself and EBNet. It's been a fantastic partnership, and you guys have done a great job on this.
Well, I'm going to close off the series with some very profound words. It's time to drink the Kool-Aid. On that note, thanks, guys, and cheerio.
Cheers.
Cheers,
Bye-bye.
thanks. Bye.
Ladies and gentlemen, this message draws to an end the series Inside Private Markets. We hope that over the last 12 episodes, you have enjoyed the content, but gained a perspective on how you can further engage to take advantage of the private market opportunity that we have. Not only can it drive returns for you, but also help us develop the South Africa that we want to see tomorrow. On that note, I would like to thank our sponsor, Old Mutual Alternative Investments. It's with their support that we've been able to bring this educational series to you. I'd also like to take the time to thank our guests who joined us to share in their particular area of expertise to help us all better understand private market investing. Finally, I must thank the team behind the scenes at EBNet, who put in long hours editing the podcasts and putting together all of the other material that is necessary. Big thank you to the team behind the scenes. On that note, thank you so much for joining us. We really do appreciate it. Feel free to come back. The episodes will live on the EBNet platform, and feel free to share them with anybody else that may benefit from the content. Cheers for now.